Question number 1. The United States has suffered from inflation problems since 2023. Therefore, it has continued to increase the interest rate. The federal funds rate has been between 5.25% to 5.5% since July 2023. In early 2024, Taiwan also suffered from an inflation problem. Therefore, Central Bank of Taiwan unexpectedly increased its key discount rate to 2% in March. The Japanese economy, which has faced deflationary pressures, has seen indications of healthy inflation in recent months. As a result, the Bank of Japan raised interest rates to 0.05% in March 2024, ending the country's historic era of negative interest rates. There has been a big gap in interest rates between USA and Asian countries such as Japan and Taiwan. Therefore, there has been capital inflow from Asian countries to USA, and net capital outflow of USA has been decreased. As a result, US dollars have been appreciated, while Japanese yen and New Taiwan dollars have been depreciated. On April 29th, the nominal exchange rate once went up to 160 Japanese yen per US dollar. However, Central Bank of Japan tried to intervene foreign currency exchange market in Tokyo on that day. As a result of intervention, the nominal exchange rate went down to 155 Japanese yen per US dollar in the end of that day. Question number 1. What is federal funds rate? Why has federal funds rate been kept at a very high level, 5.25% to 5.5% in the United States?
Hi, I'm Zhou Linghong, and the answer of question number 1 is the federal funds rate is the interest rate that banks charge each other to borrow or lend excess reserves overnight. The reason why federal funds rate kept at a very high level is aiming to slow down the inflation, increase financing costs to discourage borrow and investment, and decrease the amount of money in the market.
Question number 2. What is discount rate? Why did Central Bank of Taiwan increase its discount rate to deal with the inflation problem in March?
The answer is, the meaning of discount rate is the interest rate Fed charges banks for loans. The reason why Central Bank of Taiwan increased the discount rate is because when Central Bank of Taiwan increased the discount rate, the cost of borrowing money from them becomes higher. Banks will decrease the amount of the money they borrow. The money supply decreases, which is helpful for dealing with inflation.
Question number 3. What is real exchange rate? Use the open macroeconomy model to explain why capital flows have caused real exchange rate to rise in USA. Graphical analysis is required.
The answer is, the real exchange rate is the rate at which a person can trade the goods and services of one country for the goods and services of another. And due to the capital inflow from Asian countries to USA, net capital outflow of USA has been decreased, which causes NCO shift from NCO1 to NCO2. And the shift of NCO leftward causes the supply curve in the market for foreign currency exchange shift leftward, and therefore the real exchange rate increases.
Question number 4. What is nominal exchange rate? Draw a diagram for Tokyo's foreign currency exchange market. On this diagram, the vertical axis is Japanese yen per US dollar, whereas the horizontal axis is quantity of US dollars. Identify factors affecting the demand curve and supply curve on this diagram.
The answer is the nominal exchange rate is the rate at which a person can trade the currency of one country for the currency of another. The factor that affects supply curve is the capital inflow from Asian countries. It causes the net capital outflow of US to decrease, which shifts the supply curve to left. And the factor affect demand curve is because US dollar appreciates, which is good for import. Therefore, next export decreases, so demand curve shift left.
Question number 5. Suppose that the initial equilibrium nominal exchange rate was 150 Japanese yen per US dollar on April 28th. Show why continuous capital outflow from Japan caused nominal exchange rate to rise to 160 Japanese yen per US dollar on April 29th. Explain how Central Bank of Japan pulled the nominal exchange rate down to 155 Japanese yen per US dollar in the end of that day. Graphical analysis is required.
The answer is capital outflow from Japan means NCO of US decreases, which shift the supply curve in foreign exchange market to the left. That causes the nominal exchange rate rise to 160 Japanese yen per US dollar. To pull down the nominal exchange rate, Central Bank of Japan bought back Japanese yen, and therefore the supply curve shifts left. It causes the value of Japanese yen to increase.
Hi, I'm Zhongmeng Tim from MIS. I'm going to talk about question 2. China has experienced a fast economic growth since it opened the door to the world. The real estate sector has contributed to China's GDP significantly. However, since 2019, China's economy has suffered from a series of several black swans. First, there has been trade war between USA and China. Second, foreign companies have continued to leave China since the COVID-19 pandemic period. Third, China has been experiencing a real estate crisis with the collapse of giants like Evergrande and Country Garden. Lastly, China's stock market hits new 5-year low. So let's look at question 1. How can trade war between USA and China influence the aggregate demand in China? Explain your reasoning. So the result is GDP reduces and it makes the aggregate demands to reduces too. And there are many reasons that make the GDP to go down, and I came up with 3 reasons. The first reason is USA increased tariff of China products, so it make the next effort to get done. And also, reducing business confidence will make the investments to reduce. And the last one is uncertain economic outlook. It will make the consumption to reduce. And question 2 is, how can the leaving of foreign companies influence the aggregate demands in China? Explain your reasoning. So the result is the GDP of China reduces, and which make the aggregate demand reduces. And the GDP will reduces is because the reducing foreign direct investment, which will make the GDP to go down, and also losing job will make the consumption to reduce. And This is the question 3. How can real estate crisis influence the aggregate demand in China? Explain your reasoning. So the result is the GDP of China reduces, which make the aggregate demand reduces too. And the reason cause the GDPs to go down is because the reducing household wealth, which make the consumption to go down. And also slow down in the real estate sector, which will make the investment to go down. Question 4. How can stock markets crash influence the aggregate demand in China? Explain your reasoning. The result is the GDP of China reduces, which make the aggregate demands to reduces. And the reason is because making households feel poorer will make the consumptions to go down and also harder for companies to raise funds, which will make the investments to go down. Question 5. Use appropriate models to analyze the impacts of this black swan on China's real GDP and overall prices in the short run and in the long run. Graphical and descriptive analysis are required. Let's look at the paragraph. Because of the impacts, the aggregate demand reduces, so it moves the curve to the left, which is on the yellow line. And also, the components of aggregate demand is equal to GDP. So in the short run, which is at point A, the real GDP reduces and also overall price reduces too. And later, the short run aggregate supply line will move to the right to balance. So in the long run, which is at point B, the real GDP is unchanged and overall price reduced. And it is question 6. What would you suggest the Chinese government to do in response to the short-run economic fluctuation caused by these black swans? Explain your reason. In order to solve this problem, we need to increase the aggregate demand. So I came up with the solution is fiscal policy, which is to increase government spending such as improve defense. So in the paragraph, you can see the aggregate demand curve move to the right, which is mean that it's moved to the original equilibrium. Question 7. What would you suggest Central Bank of China to do in response to the short-run economic fluctuation caused by these black swans? So in order to solve this problem, it also needs to increase the aggregate demand. So the solution I came up is monetary policy, which is to reduce interest rates to lower borrowing costs and encourage investment and consumption, which means that the consumption and investment will increase, which make the aggregate demands to increase. And look at the paragraph. You can see the curve of the aggregate demands move to the right, which means that it's moved to the original equilibrium. And it is all about question 2.
Hello, my name is Yang Panshen and I'm from MIS. Now I'm going to talk about question 3. Following Russia's invasion of Ukraine, the European Union adopted a number of sanctions in an attempt to immobilize the war efforts. One sanction was a complete import ban on all Russian seaborne crude oil and petroleum products. The sanction sent energy prices to historic high. 1. Use a graph of energy market to explain why the sanction caused the energy price to rise sharply. Let's take a look at the answer. This ban will reduce the energy supply, causing the supply curve to shift to the left. Therefore, the equilibrium price will increase and energy prices will rise sharply. 2. How could this sanction affect overall price in the European Union in the short run? Outputs, unemployment, graphical and descriptive analysis are required. Let's take a look at the answer. In the short term, this sanction will cause the short-run aggregate supply curve to shift to the left. Therefore, the equilibrium price will increase and equilibrium output will decrease. So, overall prices in the European Union will increase and output will decrease. In addition, as unemployment is influenced by output, the unemployment rate also rises in the short run. Now, question 3. If EU authority would like to solve the inflation problem, what kind of fiscal policy is appropriate for the EU authority to implement? Explain why. So, when the short-run aggregate supply decreases, the equilibrium point will move from A to B. According to the multiplier effect and the crowding out effect, the governments can increase taxes to reduce aggregate demand. Therefore, the equilibrium point will shift to C, and the price level can return to its original value. 4. If EU authority would like to solve the recession problem, what kind of monetary policy is appropriate for the EU authority to implement? Explain why. When the short-run aggregate supply decreases, the equilibrium point will move from A to B. In this scenario, the policymaker can increase the money supply, causing the aggregate demand curve to shift to the right. As a result, the equilibrium point will move back to C, whose output value is same as A. 5. Could EU authority use a single policy to simultaneously solve both inflation and recession problems? Explain your answer graphically and descriptively. The answer is no. Inflation and recession problems cannot be solved simultaneously in a single policy. As we can see in the graph, when the price level returns to its original value, output will decrease even further. Conversely, when output returns to its original value, the price level will increase even more. Therefore, this situation is referred to as stagflation.
Question 4. In the past decades, the quantitative easy policy was often used by the major economies such as USA, Japan, and EU to deal with its recession problem. These economies could no longer use conventional monetary policy to lower the short-term interest rate due to the liquidity trap in the money market. Therefore, they choose to use the quantitative easy policy to lower the long-term interest rate. The main goal was to stimulate the economy by increasing aggregate demand. The first question is, use a graph of money market to explain why an increase in money supply cannot lower short-term interest rate, suggesting the existing of liquidity trap. Hello, I'm Chanai from MIS, and here is the graph of the money markets. As we can see,
the demand curve is a downward sloping, and it become more flatter and flatter when the quantity of money increased, which means when the money supply become more and more, which means it's move to the right, the interest rate will become lower and lower. However, the change of the interest rate is also become smaller and smaller, and at the end, even if the money supply increased, the interest rate won't change anymore, which can also be explained that even if government increase the money supply, there's people that still need money for transaction. The second question is, what is the quantitative easing policy? What is the difference between quantitative easing policy and conventional monetary policy? Okay, for question number 2, the quantitative easing policy would like to purchasing assets of longer maturity than only buying the short-term government bonds to stimulate the economics. However, for using the conventional monetary policy, since the long-term interest rates and the short-term interest rates will change together, so they tend to lower the short-term rates, which leads to lower the long-term rates and stimulate the investment spending. The third question is, please introduce the quantitative easing policy adopted by USA between 2008 and 2014. Okay, let's explain the quantitative easing policy adopted by USA between 2008 and 2014. Okay, here is the sheets that teacher used in the class to explain this policy. So I would like to just use these sheets to explain it. And we easily just divided these parts into four parts. And the first part is QE1. The reason that this QE1 is happened is because the global financial crisis and the Great Recession lead to widespread unemployment and reduce the business output. And this period is take time and March to October between 2009. And in this time, the Fed purchased about 299.9 billion in US Treasury and purchased 105.7 billion in federal agency debts, 707.5 billion in mortgage-backed securities. And for the QE2, it take time in November 2010 to June 2011. It will happen is because the business output and the employment remains below the Fed targets. And this time, Feds only purchase the long-term Treasury securities. So it's 772.7 billion in US Treasury. And for QE3, it take time in September 2012. And it is because the economic activity was expanding but doing very slowly. So this time the Feds once again turned to the unconventional policy of quantitative easing to spur the economics, and which is purchasing the mortgage-backed securities in 40 billion per month. At the end is QE4. it take time in December 2012, and this time Fed would like to Fed is purchasing for 45 billions per month in U.S. Treasury and 40 billions per month on mortgage-backed securities. The question 4 is explain why the quantitative easing policy could increase aggregate demand. The question 5 is use appropriate models to show how the quantitative easing policy would shift the aggregate demand curve and influence output and overall price of economy. Graphical and describe analysis are required. For question 4 and 5, because these two questions is quite alike, so I would like to explain it together. And for question 4, the reason that quantitative easing policy could increase the aggregate demand is because the quantitative policy would increase the money supply, and while the money supply is being increased, it leads to the decrease of interest rates, which will makes the firm more likely to borrow the money, because it means the money that they need to return is become lower, right? And because the firm is more willing to borrow money, the demand curve would increase. And here is the graph of the model that can more easy to explain the quantitative easing policy. And like I just said, while the money supply is increased, like move to the right, it will lower the interest rate, and while the interest rate become lower, it will lead to the short run aggregate demands move to the right, and leads to the increase of quantity of output, quantity of output, also the overall price of economics.
Hi, I'm Chen Mingyu from MIS. So let's look at question 5 together. So the question is, Donald John Trump became 45th president in USA in 2016. His economic policies were called Trumponomics. There are two main areas of Trumponomics: tax cuts and protectionism with high tariff. First, President Trump lowered the corporate tax rate from 35% to 21% in order to encourage domestic investment. Second, he imposed a high tariff on imported goods mainly from China. When Joe Biden became 46th president in USA in 2020, he did not follow Trump's tax cut policy. Alternatively, he called for tax increases on corporations and wealthy people. So let's look at the first question. In the United States, Republican Party follows the principle of supply-side economics, or so-called Reagan economics, whereas Democrat Party follows the principle of demand-side economics, or so-called Keynesian economics. Explain the difference between supply-side economics and demand-side economics. So do you know the answer? Okay, let's look at the charts together. As you can see on the chart, there are principle, policy measures, and belief. Let's look at principle first. For the supply-side economics, they focus on increasing aggregate supply to stimulate economic growth. And for the demand-side economics, they focus on the role of aggregate demand in driving economic growth and employment. And as for the policy measures, supply-side economics, tax cuts for business and high-income individuals, deregulations, and incentives for investments. And as for demand-side economics, increased government spending, tax cuts for lower and middle-income individuals, and monetary policy measures to boost consumption and investment. And last is belief. For the supply side economics, lower taxes and reduced regulation will lead to increased production, job creation, and overall economic growth. And for demand side economics, during economic downturns, government intervention is necessary to boost demand and pull the economy out of recession. And let's look at the second question. By following question 1, explain why President Trump implemented tax cut policies, and while President Biden implemented tax increase policy. So, do you know the answer? Okay, let's look at their reason together. So, as for Trump's tax cut, Republican Party aligned with supply-side economics. Their goals was to stimulate investment and production by reducing the corporate tax from 35% to 21%. And as for Biden's, Democrat Party aligned with demand-side economics. Their goal was to increase government revenues to fund public investment and social programs, thereby boosting aggregate demand. So let's look at the third question. As mentioned, the corporate tax rate was reduced to encourage domestic investment. How can this Trump's policy influence the market for loanable funds in the USA? And what happens to real interest rate, net capital outflow, real exchange rate, and the trade balance in the USA? So, do you know the answer? Okay, so let's look at the graphical analysis. First, the supply and demand for loanable funds. The tax cut is expected to increase the supply of loanable funds as business and individuals have more after-tax income to save and invest. These shift the supply curve of loanable funds to the right. And look at the real exchange rate. The increase in the supply of loanable funds lower the real interest rate. And as for net capital outflow, lower real interest rates in the U.S. makes domestic financial assets less attractive to foreign investors, so these increasing net capital outflow. And let's look at real exchange rate. With increased net capital outflow, the supply of dollar in the foreign exchange market increases, leading to a depreciation of the dollar. And last, the trade balance. A weaker dollar makes U.S. exports cheaper and imports more expensive, which can improve the trade balance. So let's look at question number 4. A high tariff was levied on imported goods to reduce trade deficit of USA. How can this Trump's tariff policy influence the market for foreign currency exchange? What happens to the real exchange rate and the trade balance? So do you know the answer? So let's look at the graphical analysis. You can see in the graph, the imposition of tariff decrease the demand for the foreign currency as imports drop, shifting the demand curve leftward from D1 to D2. And the reduction in demand for foreign currency causes the dollars to appreciate, reflected by the increase in the real exchange rate from E1 to E2. So let's look at the trade balance. The stronger dollar makes U.S. exports more expensive and imports cheaper, which can affect the trade balance contrary to the intended effects of tariffs. So last question is number 5. Many economists oppose Trump's tariff policy. They think that Trump's tariff policy could not solve the trade imbalance problem with China. So explain why economists think that way.
So do you know the answer?
Okay, so although the net export increased in the beginning, the change on both supply and demand curve increased the real exchange rate once again, which means that import will increases. Therefore, trade balance will be deficit in the end. So that's why many economists oppose Trump's tariff policy.